Good afternoon, and thanks for joining us for today's webinar entitled Nonprofit Organizations and the Impact of COVID-19 on Financial Reporting and Your Organization. My name is Janice Snyder, Partner and Director of Assurance Services at McKonly in Asbury. And with me today is Gary Dubas, Partner and Director of Nonprofit Services, and Jim Shellenberger, Principal. As you can see, we all specialize in serving our nonprofit clients. If you have any questions for us during the webinar, please submit them through the built-in questions function in the webinar control panel, and we will do our best to answer them during or after the webinar. There will also be 3 polling questions throughout, so be sure to answer those if you are looking to obtain CPE for today's webinar. Our first slide here is an overview of the firm and some of the industries that we serve. You see down there on the right, we serve lots of nonprofit organizations. Just so happens that alphabetically they come last, but certainly not least. And we're all glad that you could join us here today. The outline for today's webinar is considerations for nonprofit organizations. We're going to start out with some financial reporting and no surprise, talk about PPP loans and some other funds that are out there and other things you should be thinking about for your 6/30 year ends. We're going to talk about some of the deadline extensions and rescissions of some of those extensions that just recently happened and some other regulatory requirements that will affect nonprofit organizations, as well as some of the audit implications and some of the things that have changed as a result of our changing environment over the last several months. So we hope you will find this very useful as you look forward to your 6/30 year ends, or maybe some of you are still wrapping up your 12/31 audits, or some of you that have other year ends in between. So with that, I'm going to turn it over to Gary Dubas to start off with some of our financial reporting considerations.
All right, thanks, Janice. So as Janice mentioned, we're going to talk about PPP loans. Again, Paycheck Protection Program loans. And interestingly, there has been 6 webinars that we have done since March 31st that have at least mentioned these PPP loans. So this will be number 7. So 7 hopefully is a charm for everybody as we're going to talk about PPP loans. By the way, you have a couple more days till June 30th to apply for a PPP loan if you haven't gotten one. So could still get one in under the wire. So let's talk about some recent changes. Again, key changes here to these loans. The original CARES Act back in March had the covered period for the loans defined as 8 weeks following the funding of the loan. So the day that you receive the money in your bank, you'd have an 8-week period to go ahead and spend the money, utilize the money for the loan. And talking about debt forgiveness, loan forgiveness regarding the 8-week period. So now with HR 710, the new legislation, the covered period is now defined as 24 weeks following the funding of the loan, or December 31st, whichever comes first. So much flexibility now in spending that money and having a better chance at total loan forgiveness going through a 24-week period now. Now, June 5th is an important date. So before June 5th, the borrowers are not required to adopt the 24-week period. You can still do the 8-week period if you're a pre-June 5th borrower. And those post-June 5th can only use the 24-week period to deal with the whole debt forgiveness issue. Also, so the initial SBA guidance stated that of the 100% loan forgiveness, at least 75% of the loan must be used for payroll costs. And the other 25 would be then used for the other items that are forgivable, mortgage interest, rent, and utility costs. Now, only 60% of the proceeds must be used for payroll costs, and then the 40% for the other. Again, it's some additional flexibility. Essentially, it just gives you much more of the ability to have total debt forgiveness Now, of course, when you have 24 months and you've got operations and payroll, you can certainly have more than 60% of the proceeds used for payroll. And that would obviously not be an issue at all. And loan forgiveness is not all or nothing. And it's similar to the initial SBA guidance as it relates to forgiveness and use of funds. So in other words, if less than 60% of the funds are used, the loan forgiveness will be reduced proportionately as outlined in the original guidance. Essentially, you can use only 70% of the loan forgiveness. So it's not all or nothing. It's not 100% loan forgiveness or nothing. So it's not. And for a number of organizations that have government funding and other things that reimburse their cost, you may not be able to have total debt forgiveness. And we'll talk about that a little bit as we go along.
And I certainly think that reduction from 75% to 60% is going to help a lot of organizations to get greater loan forgiveness and potentially have all of it being forgiven. So this was definitely a positive thing.
Most definitely. So extension of time to do the full-time equivalent has also been extended. Borrowers had originally until June 30th to restore their full-time equivalents and salary levels. Now you have until December 31st to reestablish your full-time equivalents, where if you did not do that, you would have potential for reduced loan forgiveness. So again, additional time to get operations back to where they were pre-COVID-19 in terms of your personnel. Here again, something additional when it comes to key changes. Borrowers had originally 2 years to repay the loan that was not forgiven. Now, post June 5th, borrowers have 5 years to repay loan proceeds that are not forgiven. So you've got 5 years to use a potentially a 1% interest rate loan for other things that if you have money that is still not forgiven. So 5 years for a 1% loan, pretty good deal.
It's a fantastic deal, Gary. I haven't seen anything like that in the market.
Yeah, I'd like to have that deal for, and maybe go out and buy a car or something like that.
Don't think that would fall in line with these requirements, Gary.
No, that would not be forgivable. So let's talk a little bit about the accounting for the funds. So as nonprofit organizations, with the recent guidance put out by the AICPA, you have to make a choice in terms of how you account for this on your books. If you believe the funds are actually a loan, then you record as a loan upon receipt. So you credit the loans payable, and then you reduce the loan balance when forgiven up to the amount forgiven and record that as other income. So that's going to show up again as kind of a miscellaneous, kind of a separate material item on your financial statements as other income. Now, if you believe the funds are not really a loan, but potentially a contribution, you have to use contribution accounting then. Record revenue, the loan proceeds when you get it as a refundable advance liability. And then when conditions have been substantially met, recognize the contribution, this contribution revenue, again, when that happens.
So Gary, I'm going to ask the question I think a lot of people are probably wondering, what is the right choice? Like, how do I know that I made the right choice?
You know what, this is one of those situations where teachers often would say, hey, there's no right or wrong answer.
Yeah.
So you can do either one, and both of them get to about the same place. You're going to have the same revenue. It's either going to be called a contribution or other income. And you also would have a liability for any proceeds that still remain as a loan. You're still going to have either a refundable advance or again, or a debt payable on your books.
I do think when you look at these two options, though, if you're a 6/30 year end, you could end up with a timing difference. If you choose the contribution, you have to prove you've substantially met the criteria to have that be forgiven, so it can be a contribution and show up as income. Whereas if you choose debt, your debt may not have been forgiven as of June 30, so you could have some timing differences in that income.
That's very true. And so the next thing on the slides here is what does substantially met mean for your organization? So as auditors, we're going to look to the organization and say, you know, have you substantially met the requirements to recognize the other income or the contribution revenue for loan forgiveness? You've got to look at you know, things such as the incurred cost. Did you in fact incur the cost? Have you in fact went through and did the application for loan forgiveness? Have you done the calculation? Are you substantially assured that you're going to in fact have the debt forgiveness? So we're going to, as auditors, we're going to be looking for substantial things, because we would rather recognize it in the subsequent period when it actually comes, you know, that it gets totally approved versus in the middle of the stream, so to speak. So you've got to get your ducks in a row if you're going to record it as a contribution and make sure it's substantially met.
I certainly think it will be interesting to see the organizations that go through the exercise and have their calculations in line and have all that support and can prove they've substantially met, whereas another organization that may have done very similar things but don't have the documentation and analysis in place, they may not be able to prove that they've substantially met it, and the timing of that income could change from one organization to another, depending on the amount of work they've done to prepare for their year end.
That's exactly right. Regarding accounting for the funds, best practice is to use separate expense codes to track the forgivable expenses. You've got to track those within your system. So anything you can do to make your system utilize your system to track those costs. Potential interest material enough. If you're June 30th and you know, even if you've got the loan in April, it at 1% interest rate, it may not be material enough to worry about accruing it, but you have to at least think about it. And here's the next thing is double dipping, which, you know, Jim, I think you like ice cream. That's usually a good thing when it comes to double dipping, but here, this is with basically saying is you can't get the situation in which you have debt forgiveness and then the same cost, those payroll cost variances, are also being reimbursed by a federal revenue source, grant. So you can't do that. And I've got a number of clients that are in that situation that most of their payroll is reimbursed through a federal program. You cannot have those costs be reimbursed by the federal program and also by loan forgiveness. So something to keep in mind. And these funds are also another thing to keep in mind. Also, they're not subject to single audit.
Gary, I had a question come in. I'm gonna share it with you here, and just as a reminder to all the attendees to use the built-in chat function of the webinar software to send us questions throughout the presentation. And the question, Gary, that came through on this slide, if the funds are not subject to single audit, what type of oversight is in place to provide assurance that the funds are utilized as intended?
That's a good question. I believe the legislation says that any loan that's over $2 million. Yep, right. Yep. $2 million. Is that right, Jim?
Yeah. So the burden for audit will be $2 million and plus. I think this gets to a lot of the responsibility of the lending institution too, to see what type of oversight that they're going to provide, and looking through the documentation once that forgiveness application is completed and submitted.
That's exactly right. You know, the 2 million threshold, you know, subject to potential audit above that if you've had over $2 million in the loans. And again, the financial institutions that are giving you the loans also are going to be looking at things when it comes to debt forgiveness and getting their documentation all squared away. Let's look at next thing is payroll taxes. So payroll taxes due from March 27th of this year to the end of the year can be deferred. So half of those would be repayable by December 31st, 2021, I'm sorry, and the remainder another year later, December 31st, 2022. So previously, the deferral, you couldn't do that if you had a PPP loan. Now you can. So organizations have to think about that. You know, here's another place where you can defer having to pay your payroll taxes with the cash, hold it, and then pay it later. And you'd have a liability on your statement of financial position, of course, for any of those deferred payroll taxes.
A potentially very long-term liability when you're considering payroll taxes that's generally included in your current liabilities. So that's a shift in a lot of the reporting.
And I always, I think of cautioning organizations to think about the fact is that you defer this, you have a liability on your books. Well, you know, you got to have that money when day comes due, December 31st, 2021, to repay these funds. So it's a liability, but it's an unfunded liability, so to speak, unless you set those funds aside. And that can be a real predicament to be in down the road if those monies are in fact spent. So first polling question is your organization deferring payroll tax liabilities? Please select one, yes, no. No, but we're going to do it now that we know about it. Or I don't know.
Yeah, some organizations may not have been deferring them with the PPP loans, but now they're finding out they can defer them and have the PPP loan as well. So that could definitely be a shift for some of the individuals here.
Get your answers in. Oh, by the way, you do have to answer these if you're going to get CPE. So continuing professional education for those accountants out there, you've got to answer the questions.
Give you guys about 15 more seconds. Gary, do I have to answer this question to get CPE, or am I good?
I think you're going to be okay. All right, so who's going to defer payroll tax liabilities? 11% say yes. Almost 60% no. I don't know, 28%. So maybe some new information here today to think about.
Well, and I think it's pretty great that 60% said no. So potentially that means they don't have to. So that's a great thing if you're in a position that you have cash and you're able to pay these and you're able to fund them today. So I see that as a very positive sign as 60% are able to say no.
And just a couple other things here regarding loans and debt. Don't forget any other potential loans, line of credit. You know, maybe you picked up a new line of credit along the way. Those types of things, get those recorded on the books, accrue the interest. And final bullet there, debt covenants, is if you do have the debt covenants part of your loan agreements, existing loan agreements, do the calculations. Too often, we as the auditors come in and do those debt covenant calculations and find out whether you're going to meet them or not, but be proactive and go through those covenant calculations and have a conversation with your bank if in fact you're looking like you're not going to make those debt covenants. We'll move on, I believe, to who's next? Is that you, Janice?
It is. Thanks, Gary.
Right. Okay.
So we're going to talk a little bit about subsequent event disclosures. So still issuing a few 12/31 year-end audits. They're still in progress, and we're certainly seeing disclosures not only related to COVID-19, but we're starting to see now PPP loan disclosures, whether or not individuals expect they'll be forgiven, if there's any other new debts, EIDL loans, if you're having new grants, anything like that. If you have extensions of current terms of your debt that you may be disclosing in subsequent events. So some of these footnotes can get rather lengthy at this point because so much stuff has happened in 2020. You also may want to consider significant changes to operations for your subsequent events. Have you had to temporarily shut down? Will you be closing any locations going forward? Were you unable to fulfill your mission for a period of time and be able to serve those that you would typically be serving? So these are all things to think about that you may need to disclose. As we get closer to 6/30, I'm certainly seeing more and more things that are coming into these disclosures. On the next slide, we have an example of what's showing up in a lot of our 12/31 financial statements for nonprofits as well as for-profit entities. It's kind of a catch-all that says the world has changed and it has affected our organization, and we're not really sure what all that means right now, but we're telling the reader there's all sorts of possible things that could be impacted, as you can see them there. And certainly we'll be talking more about some of these things on the next couple slides, as well as we get to some audit implications. So something to keep in mind, you will have subsequent event disclosures, even if you're not accustomed to having them in the past. And we will be talking about the things that have changed in 2020 or even subsequent to your 6/30 year end in those financial statements. Another financial reporting item for nonprofits to consider are your liquidity disclosures. So a lot of financial statements, these are near the front, maybe footnote 2 or footnote 3, depending on how your notes are disclosures or how your footnotes are designed. But you do have to show quantitatively and qualitatively the financial resources of the organization. And this is your chance to really talk about, tell your story, and to say how you manage these funds and do you have enough funds to fund general operations looking forward. And that may look pretty different this year, that 6/30/2020 compared to 6/30/19 when you look at this footnote, and you may have a very different story to tell. So there is some flexibility with what you put in here and what information you want to convey to all of those stakeholders about management's plans and how you're looking forward. So whether that's your board, your grantees, your potential donors, you certainly have some flexibility in the story that you're telling here. So something you'll want to think about probably a little sooner rather than later, particularly as you're closing your June 30th books. Another thing to consider, which is a potentially positive thing, is new revenue streams. So I've definitely heard from some organizations that are in nonprofits that are in specific industries where they go, wow, this government agency or this entity put X thousands of dollars into my bank account, and we're trying to figure out what do we have to do with that? What are the restrictions on that? Certain things as this is only to test for COVID-19, this is to diagnose for COVID-19, this is to cover certain overhead costs related to that. So some organizations are in the position that you're just trying to figure out how they're required to spend that money and what the restrictions are on those funds. So definitely not a bad thing, but they're getting their hands around that and making sure they're accounting for that. And then also going, if you have new revenue streams, does this funding trigger a new audit requirement? We said PPP loans are not subject to the single audit, but may have other requirements if you're over $2 million to have a different type of audit by the banks for forgiveness. However, EIDL loans are subject to the single audit. So we'll have to take that into account and know where the money's coming from and what those requirements are. And it'd be better to figure that out sooner rather than later. You don't want to be up against a 10/31 deadline and figure out at the end of September or early October that you have a whole new audit requirement or that you need to pull a new revenue stream into the single audit. So certainly something to be talking to your auditors about and thinking about right now. And how is management looking at these revenue streams and the timing of recognizing them? And you'll hear a couple times you can't double dip on a lot of these funds. If they're in PPP, then they should not be part of your single audits, and you need to make sure you're not double counting some of those salary expenses and things like that. And making sure you're getting the timing of recognizing that revenue appropriate in those financial statements. So this could be a good thing for sure to get additional revenue streams, but make sure you understand what those streams are and that you're doing the right things as an organization to make sure you don't have to give them back. The next item to think about is functional expenses. And this was actually kind of fun as Jim, Gary, and I were talking about this. Just really thinking through, you may have put a really good methodology in place last year and you're allocating these costs and you had really good schedules, and then 2020 hit and the world changed, and the way you're allocating those expenses or the way you were delivering your programs and fulfilling your mission has dramatically changed. And it's likely you're going to have to go back for some of these costs and say, is this the appropriate way to allocate them? Or maybe we were shut down for 8 weeks and we were still paying salaries because we got a PPP loan. But we got to look at where those monies really program expenses in the current year. Is more general and administrative costs. Is there more fundraising now that you're trying to go out and raise more funds since you were closed down for a couple of weeks or months? So things to consider. So you don't want to just, you want to make sure you're not just taking what you did last year in terms of your functional expenses and repeating that. You're probably going to have to take a hard look at them again and make sure you're allocating those costs in the most appropriate way.
I know when I've been speaking with a lot of my clients, Janice, that time frame of end of March and April, it was kind of all hands on deck to get, the mission of the organization completed. So you had people in the accounting and HR department providing services where they could. How is that being reflected in your functional expense? It might not have a huge impact potentially, but it has the potential to for certain organizations where shifting of time definitely happened.
Definitely things you want to be thinking about and considering. And now, June 25th is a perfect time to be doing that. So the last slide here on our financial reporting section is sort of a catch-all for some other items to think about. So we put asset impairment there. That's pretty broad. If you remember back to the subsequent event disclosure, we talk about things like, are you going to be able to collect all of your receivables? If you have inventory, could your inventory be impaired? Could goodwill be impaired if you have that, or intangibles? So certainly things to think about as the organization has probably changed in the last few months. Have you had to temporarily close or shut down your mission? Have you had to close any locations? Is there anything that will be discontinued sort of permanently that you don't intend to reopen that portion of the organization or that location? So things you should be thinking about and making sure you're getting the reporting for that correct as of June 30th. The last one that has potential to be a positive thing, if some organizations were able to recover anything for business interruption insurance, how are you recording that? Is it other income to you, or should it be accounted for in some other way, depending on how those funds came in and what that was actually compensating the organization for? So just a few things to think about. Certainly for some organizations, not the most significant items, but certainly things you don't want to forget as you're closing your books for your year end. So that wraps up our financial reporting section. And I'm actually going to turn it over to Jim to talk about some of our deadline extensions, changes, modifications, whatever they may be.
Exactly. It seems like it keeps changing by the day. Thank you, Janice. Again, just a reminder to use that built-in chat function. Janice, Gary, and I love getting questions, so the more that you guys can send, the better this presentation will be and make it a little bit more interactive. So back when we did our initial presentation webinar a few months ago, I reported about the OMB releasing a blanket 6-month extension, and that was very well received within the nonprofit community, especially for those organizations who are right in the middle of having their single audit being completed, or were getting ready to have it completed. But it caused some confusion for those organizations with the June 30th year end, who could potentially have up to 15 months to complete their single audit, which just seemed kind of ridiculous to me. And to the rest
I thought that could be confusing. You could be finishing the next year's audit before you filed the previous year's.
which is just ridiculous. So what the federal government gives, they can always take away. And on June 18th, they came out and took away that blanket 6-month extension for single audits and revised it. Essentially, fiscal year ends of December 31st now have until the end of this calendar year to get their single audit completed. And those June 30th, 2020 year-end clients, year-end organizations, you're back to the old rules of the earlier of 9 months after year-end or 30 days after you finish your audit. That has to be reported. No impact to the low-risk auditee status if an extension is used correctly. That's a question I've received a few times. And there's also no approval that you have to seek if you are using the extension. That is an automatic extension if you're able to use it. Why did they pull this extension back? Really, I think it's an opportunity for the OMB and the federal government to have a more responsive oversight of some of the funds, not necessarily the PPP funds because they're not subject to single audit, but some of the other COVID-19 related funds that have been dispersed, and get some earlier monitoring of those uses. Okay, next slide, Janice. So as a reminder, Gary mentioned it earlier, the PPP funds are not subject to the uniform guidance and not subject to a single audit, and the EIDL loans are. Now, there are many other COVID-19 programs that were a result of the CARES Act back in March that were provided from federal agencies. I actually keep a list on my desk, and I know Gary and Janice can see me waving it on the camera right now, of 4 pages worth of additional funding streams that have come out, things such as the Coronavirus Food Assistance Program through the Department of Agriculture, or the Provider Relief Fund from the Health and Human Services Agency. There is not essentially clear and consistent guidance on each of the programs. The AICPA has published a list for auditors to use to determine whether those funds are applicable to the uniform guidance in the single audit. And we hope that the 2020 compliance supplement, which is set to be released within, I'm afraid to go on record here, but within the next week to 2 weeks, that would have some more guidance in there for us regarding the applicability. So it's not just PPP funds, not just EIDL loans. If you did get other funding, as Janice mentioned before, it might have some strings attached to it.
Jim, I know you're in charge of questions, but I'm going to take a moment and ask you a question that came in. So the EIDL, the first 10,000 being received is being used as a grant. Would that be recorded as other income? The first portion of the EIDL loan?
10,000, that is not considered a loan, would be considered income. So it definitely would not go to your statement of financial position, go directly to your statement of activities, and would show that as other income.
Okay, and they also said they haven't seen any changes for the use of these funds, and they used it solely for paying employees instead of doing layoffs. So is that an eligible expense for grant consideration? Yeah,
based on the information included in that question, that does appear to be the case. Yes.
Okay, great.
Janice.
Thanks, Jim.
So back to the slides here. The memo that took away that 6-month rule last week also clarified the no double dipping of expenses that Gary mentioned earlier. That question came up immediately after the receipt of PPP funds. You know, the concept of double dipping, and actually there's a guidance out there regarding it. And specifically, it says that any payroll or other related costs that are paid with PPP funds or any other CARES Act program funding cannot be charged to any current federal contracts or agreements. So no double dipping. As much as you want to, you can't.
I think this certainly can, it sounds like it's not that difficult, but if you get into the details and you're starting to practically apply this, like you have an overhead grant or something like that, and then you're trying to make sure you're not double counting any of those payroll expenses, I think that can be a little bit challenging to follow all those funding streams and keep them separate.
Yeah. The other, what I found to be the most interesting aspect of this memo that came out from the Office of Management and Budget is that they are requiring federal agencies to communicate to recipients that they must, and whenever you're talking about government language, the word must means you have to do it, exhaust other available funding sources to sustain workforce, and also implement steps to save operational costs to preserve federal funds. the OMB and I assume other entities are going to start getting questions of how do you go about doing this. I'm hoping for more guidance coming out by the end of the month in the compliance supplement, but essentially there's been directive to say you, as a recipient organization, must take all necessary and practical steps to exhaust all of their fundings before and to essentially save federal funds, and that you must maintain documentation of how you do it. So that's going to be interesting for a lot of organizations to comply with. And finally, any COVID-19 Emergency Act funds that you did receive that are required to be subject to the uniform guidance need to be included and identified separately on your schedule of expenditures of federal awards.
Anyone who doesn't know what that is lucky, because that means you haven't needed a single audit. So.
Yeah, consider yourself lucky there. About a month ago, our Financial Accounting Standards Board came out and provided 2 separate 1-year extensions to 2 accounting pronouncements that impact nonprofit organizations and other organizations that were aimed at providing relief to organizations. The first one being revenue recognition and 606. We've done a number of webinars on 606 and we've talked about 606. So essentially, this is now being delayed until fiscal year end 12/31/20 and 6/31/2021. You have another year to comply. I know some organizations were in the middle of adopting the standard and making the necessary changes to their financial statements. If that was the case, you caught the magic bullet in a way and decided, hey, I can delay this one extra year. Now, it's important to note that the not-for-profit contribution guidance, which is known as ASU 2018-8, was not extended. So that is still applicable to 6/30/2020 year-end organizations. And what that is the guidance that said if you're not following 606, you follow contribution guidance and introduce the element of a conditional contribution. Also looking at things such as commensurate value and determining whether a right of return and conditions are present with a contribution. A lot of government contracts and government grants that were previously accounted for under revenue recognition are now under this guidance and require a little bit of additional analysis. So that was not extended, but 606 was.
I would definitely say, Jim, I'm seeing a mix on organizations that are 6/30 year ends that are planning to take advantage of this deferral and ones that aren't. Some have said, you know, I'm already very far down a path. I've done my assessment. I've looked at the additional disclosures that are required for revenue recognition, and let's just continue with it. And others are breathing a sigh of relief, going, you know what, I was behind. This is great. I'll take the extra year, and they're very excited about this. So I think it depends on where you were in your implementation process.
I completely agree, and this industry has had a lot of stuff to happen in the last few months, and if you haven't invested the time to adopt this, it might be worth it to delay. The final extension was on lease accounting. As Gary and Janice and I prepped for this webinar, we joked that we're all going to be retired by the time we actually have to implement leases, and the FASB gave us another year to make that happen. So now lease accounting and lease standard is now required for fiscal years beginning after 12/15/2021. So those are the 6/30/2023 year ends as well as 12/31/2022. Some time out there for us to get there, Janice, right?
Yeah. I have had some clients joke that, is it ever really going to happen? And I said, yes, I do believe leases really will happen. Public companies have already implemented this standard. I don't see it being deferred forever, but I think it was more my clients, Jim, that said they were hoping to retire before this became effective, and now they deem it more likely. So there are certainly a few of them out there that don't want to deal with leases.
That's right. That's right.
I don't blame them.
And finally, some extensions regarding some tax filings. When I reported this back to the group in early April, we reported that essentially everything that was due to the IRS from April 1st through July 15th is due July 15th. That is still the case as it is today. No additional extensions have been made. So those fiscal year ends 12/31/2019, right in the middle of the slide. Your 990 is due on extension by November 15th, and upcoming year-end fiscal year-end clients follow the same time frame that you had in the past as well. And finally, with the Pennsylvania and the filing of the BCO10 charitable organization registration statement, they also provided extensions for those that were due during April, May, and June for 3 months. So we're going to revert back to the old deadlines for our June 30th, 2020, and on extension, those will be due on May 15th, 2021. So no real changes to update here as well, but as we have learned over the last 3 months, things could happen overnight, and we will certainly apprise everybody if there are additional extensions. So with that, I'm going to go into polling question number 2. And of these extensions that I just reviewed, which one seems most likely to be utilized within your organization? Tax filings, revenue recognition, leases. Sign me up for all the extensions, or you know what, I'm not going to use any of them. None. I know, and what I'm seeing, I would say definitely the tax filings have been utilized a lot over the last 3 months, and I suspect revenue recognition as well. Gary, Janice, which one of these 3 do you think you would choose?
If I was thinking about it today, they're certainly the more short-term ones that most organizations want to take advantage of, but I think everybody's going to take advantage of leases. I just don't know if that will be the choice, because when you're looking 2 years out, it's really not that big a deal today.
Great. And past experience tells us we might get another 1-year extension. Who knows?
I wouldn't count on that, Jim.
So I'm going to give you about 10 more seconds to answer that question, and we'll see the results. Well, pretty split results here. In fact, 25% tax filings, 15% leases, 20% of you all of the above. The revenue recognition number is a little bit lower than I thought it would be, so that's interesting. And I applaud 1/3 of you who have decided not to use any of the extensions and stick to the original deadlines and timelines.
Jim, they're all great. They're on top of RevRec.
That's awesome.
There's nothing to be concerned about. Very positive sign.
Great. Now we're going to move it over to Janice. I think you're going to talk to some of the audit impacts that we want to go through.
That's right. So as we move into, a lot of you are June 30th year ends. We're moving into an environment where many organizations are still saying no guests, no visitors, or they're very limited. Even if you were deemed a life-sustaining business and stayed open the entire time and have your employees there, a lot of organizations are still pausing and saying, you know what, we're just really not having guests. We're seeing that open up a little bit, I'd say just in the last week. But we are getting a lot of questions, even looking 3 and 6 months out, going, can you do this entire audit remotely? The short answer to that is yes. There are some challenges and things to think about, and certainly a lot of lessons that we've learned as we've been remote for the last 3 months. And when we say staff availability and in office time, we really mean your staff as the client. When are you available? When can the audit team touch base with you? An audit still requires a lot of interaction, a lot of documentation to support transactions and things recorded in your books, and a lot of dialogue between the auditors and management. Does your team need to be in the office? We've had some clients say, well, I probably can't get into my office for another month. And I need to scan a whole bunch of documentation to you. So that certainly adds some time for management. If you have everything electronically already, that's great. That's going to make this a lot easier. If you don't, and you are looking at a remote audit being performed where we're pretty much off-site and not coming into your location, there's a lead time to that. There's time to prepare that information. There's time to scan that information, and making sure that's built into any kind of audit timeline that you may not have had to in the past because you would have just handed it off to the auditors on the day they arrived. Some other challenges to think about. Yes, we have done several remote inventory observations. The AICPA and the audit standards around that do allow use of video cameras and things of that nature. We've used FaceTime, we've used Skype, Teams, Zoom, whatever works best for the organization to observe and count inventories. That does take a little longer than if you were there in person because of the coordination and the questions and the things that need to occur. Internal control walkthroughs, we look through there. That's best done with screen sharing and things of that nature. Again, these can all be done. It just looks a little bit different and requires a little bit more planning. We've had some clients early on that said, you know what, you usually walk into my office a couple times a day and we answer questions quickly and we resolve them. Let's touch base twice a day for this week while the audit's going on, or 2 weeks, whatever that may be. Sometimes that's too much and they say once a day, but what does that need to look like? Others are saying every other day, as they'll get their lists and their requests and a lot of back and forth. So it's really about setting expectations and figuring out what that needs to look like. Or maybe you're in the boat, your audit's a little bit later and your organization is open and you're like, it's business as usual. I haven't heard a whole lot of that so far. But in the COVID-19 world, a week or two can seem like an eternity, and everything can change just that quickly. But these are the types of discussions that you should be having with the auditors and types of expectations you should be setting. And we're still talking about some audit committees and boards are meeting and doing it virtually and using technology. And some are not. And I think that depends on your organization, and can you delay things and can they wait till you can be together in person, or are things just going to keep moving forward in a remote fashion? We're certainly adapting to whatever the needs of the organization are. I can say most organizations are having those remote board meetings, but you have to figure out what works best for your board and your audit committee and for your organization. Anything to add, Gary or Jim?
I think
just plan ahead, really, and work closely with your auditors throughout the whole process. I think communication is even more paramount than maybe even normal.
All right,
Great.
I'm going to turn it over to Jim.
Yeah, I want to talk briefly about audit finalization. As we've discussed, there's a number of new reporting requirements and new things to consider, and as I said earlier, the rules seem to be changing almost used to say overnight, but maybe now weekly. So there's new rules, new disclosures. The earlier that you can get the audit finalized, the better, because we as auditors are required to do procedures from the time of the period at the end of your balance sheet, 6/30 or 12/31, through that report issuance date. And the longer that period of time goes, the more work that we need to do, and also the potential for some significant reporting changes to your organization. So this slide's really kind of an encouragement to get things done quickly.
Well, Jim, it's not all about us. That can be more work for the client as well. You might have new
absolutely.
New lending and new requirements and things to consider that have to be added to those financial statements.
Yeah, I mean, if you received an extension of a loan agreement, and perhaps that was a 3 or 4 month extension, and then now that might have expired, and having to go back to the bank to get another extension, another waiver, all that stuff can add time to the audit process and the finalization process. Even things I put on the slide, management representation letter, having the ability to electronically sign the management representation letter has proven to be somewhat of a challenge for some organizations who might not have the ability to do that. So thinking ahead, how you're going to sign that letter, how are you going to review the financial statements with your team, how are you going to discuss them with your board and your audit committee prior to that finalization, and just really focused on wrapping that up as quickly as possible.
Gary, you've gotten to talk about debt a lot. We're going to turn it back over to you.
I didn't think this was my slide.
That's all right. If you don't want it to be, I can talk about it too.
I'm going to throw the curveball here, Janice, late in the game. That's all right.
Trying to catch you off guard.
Well, we've already gone through this, really almost everything on this slide. So in all honesty, meeting debt covenants, again, looking at those, obtaining waivers when necessary, early communication with the bank if that's the case, and then again, we talked about subsequent events and liquidity disclosures and any uncertainties, working with your auditors to get these disclosures on the financial statements as required.
Yep, I definitely agree, Gary. Working closely with your bank and keeping them informed of where you are and what your timelines look like, because they could look different this year, or things could be later, or things of that nature, and making sure that they're well aware if you don't think you're going to meet those covenants and you're being very proactive with the banks. That will certainly help. And I'll continue here. For some organizations, this period of time will have been a little more challenging for them than others. So management is required to evaluate that you will be in business and continuing operations 1 year from the date the financial statements are issued. So again, Jim talked about that timing. The further your audit drags out, the further we as auditors and management have to look forward to make sure that debt's not coming due, make sure you're not going to fail covenants in future periods, and making sure we understand kind of what that means and the impact on the financial statements. So certainly an elevated concern for a lot of organizations. So management will have to go through that assessment and maybe have to go through it more than once if the audit it ends up being later than normal, as well as adding those subsequent event disclosures and additional financial statement disclosures. Something to keep in mind that management does have to address if you have, current ratio issues or cash outflows from operations, or you're sustaining large losses, that management may need to be disclosing their plans in relation to those items and what they're doing to address that. So it's probably not unusual that the liquidity footnote could include a lot of those plans and a lot of those forward-looking things and the steps that management is going to take. And if you're an organization that didn't have to get into that level of detail in the past, it's something you should be thinking about right now, even if you don't end up at a full going concern, and we hope you don't. You still want to think about what you may need to disclose to all of your stakeholders. And then as we wrap up the audit, could there be any modifications to the audit opinion? So if liquidity is certainly a really big deal, we may have to draw attention to that footnote and say, here are management's plans, and here's how they've gotten comfortable, and we have as well, that everything will be okay and they will continue. So we may need to draw the user's attention to that in the opinion. And if financial results are not that good and you compound that with some covenant issues or some debt coming due and things like that, there could end up being a going concern paragraph in those financial statements, or potentially even end up with a qualified or adverse opinion on the financial statements. So certainly not where anyone would want to be. Certainly have had a few of these discussions. I'm glad it's only been a few with some organizations, and they get to an understanding of why we may end up with that opinion, but certainly something you would want to be in front of and be prepared for should your organization be in that situation. All right, we are on to our last polling question. I know you've all been eagerly waiting question number 3, which will solidify your CPE, and we are at the 53-minute mark, so no issues getting that. So what audit implications will be the most challenging for your organization? So certainly select the one that would be the most challenging, whether it's adapting to remote fieldwork if you're very much a paper-driven organization, or it's the covenants because it's been really challenging, the additional disclosures to add to your financial statements, or really just getting the audit wrapped up in a timely manner, given all the things that can change so quickly in the current environment. So just let us know what you think will be the most challenging for your organization. Any guesses, Jim or Gary, what will come to the top here?
I'm feeling that remote field work will be the number one. I think having to do the audit in a remote fashion is gonna rise to the top.
That would be the most pervasive, but how about you, Gary? I think you have 5 more seconds.
I'm hoping that audit finalization is not very popular, quite frankly. We want to get in and get her done.
Remote fieldwork is number 1, but audit finalization is number 2. So
come on.
We know that's always a challenge with the competing priorities. Certainly a challenge. All right. Thanks, everyone. So that leads us to if there are any more questions or any final comments, Jim and Gary, as we move to our last slide where you can get in touch with all of us.
Yeah, just, if you do have a question, go ahead and send it in. I did have one that came in, Janice, that I'll share with you and Gary. The question was, if I received a PPP loan initially and decided to return it during that window of period, do I need to disclose that in my financial statements?
No, that would not be of significance to disclose that you got it and gave it back, and so that, nope, kind of a non-issue.
Mm-hmm.
That's what I think so
Right.
as well. Yeah.
Okay, great. We all agree on that one. So any other parting comments? We hope all our nonprofits on the call found this useful as we talked about the financial reporting implications and things that are changing for a lot of the June 30th, as well as deadline extensions and things like that, and things to consider for your year-end audit. So.
Yeah, I appreciate the time with everybody. And as we've all talked about today, communication is important. So talk to your auditors, talk to your accountants, and we're all in this together.
So we're about at the end here, and I just have a couple of closing items for everybody. So on behalf of McKonly and Asbury, thank you for joining us for this webinar. It was sponsored by Jim Shellenberger Vacation Resorts Incorporated. No.
He wishes, no.
So if you have any further questions, of course, any one of us can be contacted to answer those questions. We'd be happy to assist. A recap of today's presentation will be posted on our website in a few days, so you look at that. And for those who need continuing professional education credits, those certificates will be sent out within the next 2 weeks. And I think that's it. Thanks again for joining us. Have a great rest of the week, and have a great weekend as well.
Great, thanks for joining us.